operations, paid in capital, and the balance sheet series, and here we'll be discussing dividends. So when we pay out a cash dividend, there are three things that happen. There's a declaration date, there's what's called a date of record, and of course the date we pay the dividends. So let's just discuss these three briefly. The declaration date is the date that a company announces that they're going to pay a dividend. Now, once the company announces they're going to pay a dividend, this creates an obligation to the corporation, a liability. So therefore, they would have to record dividend payable, the liability dividends payable. The date of record is a date when anyone holding stock in the company will receive the dividend that was declared. So if you, with our example here of May 2009, the date of record is the 15th. So if you buy stock or have stock as of May the 15th, you will get the dividend that was declared on May the 1st. Or you will participate in the paying of that dividend, or the payment of that dividend. The payment date, May the 30th in this case, is of course the date that the dividend is actually paid out to the stockholders. So let's look at a simple example here of the payment of dividends. We have Java Company. They earned net income of $85,000 during the year ended December 31st, 2008. On December 15, Java declared the annual cash dividend of its 4% preferred stock, and all preferred stock had been issued at par, which was $100,000, and a 50-cent per share cash dividend on its common stock, 50,000 shares outstanding. Java then paid the dividends on January the 4th, 2009. Journalize the following. The declaring of the cash dividends on December 15th, 2008. So remember we said earlier, on the declaration date, there is a liability created. So you have to make an entry to dividends payable. Well, payables are liabilities and they go up with credits. So we're going to credit dividends payable for whatever the amount ends up being. We'll calculate that here in a second. But what is our debit to? Remember, dividends is not an expense. It reduces something. It reduces retained earnings. Remember your statement of retained earnings. Dividends reduces retained earnings. So we're going to debit retained earnings and credit dividends payable. So I've already got the amount calculated here. It's $29,000, but how did I get that? Well, they tell me that we have $100,000 in preferred stock outstanding. That's how much has been issued. And we pay a dividend of 4%. So 4% of the $100,000 is $4,000. They also tell me that we have 50,000 shares of common stock outstanding, and we're going to pay 50 cents per share on those shares. That's $25,000. So $25,000 to the common stockholders and $4,000 to the preferred stockholders is $29,000. So that's how we came up with the $29,000 in dividends that we're going to be paying out. And then on January the 4th of 2009, we actually are paying those dividends. So we no longer owe them, so we know we're going to take the $29,000 out of dividends payable with a debit. But what are we crediting here? Well, we're paying our dividends. Therefore, we are crediting cash for the $29,000.